This is a Momentum Media production.
Have you thought about growing your wealth but don't know how to start? Talk to Invest by Metricon. They make property investing easy. So for all your tomorrows, build your financial future today. Invest by Metricon. Build wealth. Build today.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, g'day, how you going? Phil Tarrant, host of the Smart Property Investment Show, recording on a Tuesday afternoon after a long weekend here in New South Wales. We have a new premiere. That's all unravelled over the last sort of 4 days. No doubt you're all across it. What that means for property, who knows? I would imagine continuity with the current legislations and programs. I think the new Premier is talking about opening up the state earlier than Gladys Berejiklian. So that might happen over the next couple of days, but it's probably by the time this podcast comes out, that's all in motion. What's going to happen to some of the taxes around property, whether or not legislation is changing, we'll get right across that. Reports to follow. I think he's probably too busy trying to work out what he's going to do rather than mess around with property at the moment. But anyway, we'll watch this space. Lots happening in property right across the nation. I was having a chat over the weekend with Tom Panos, who you might know. He's an auctioneer who operates inside the sort of inner west of Sydney. He had 100% clearance rate. He was pumped. And he just see things as hot at the moment. Things are moving fast. There's not a lot of stock on market, a lot of buyers out there. So that's obviously fueling a lot of demand. However, there's been a lot of discussion recently about potential government intervention to try and slow down the property market, which means for property investors, it's going to be harder to get money. That's the way it is. We'll get into that in shows into the future. It's going to be an ongoing focus over the next couple of months, no doubt, as that happens. And we all know today also is a Tuesday. It's the first Tuesday of the month when the Reserve Bank of Australia meets. Economists are saying different things. I reckon steady as she goes. This big issue around interest rates, just keep across it. The RBA's pretty much said through COVID it won't do anything with interest rates till 2023, 2024. That may change. So keep across it all. Remember, factor in and buttress your interest repayments with your own serviceability guidelines. Don't take on as much debt as the banks will throw at you. Invest in your means. But that might be one of the themes from today's podcast. Investor stories is what we love. Pulkit Gupta, PK, is in the studio with me. He's recording from Brizzy. He hasn't been locked up. PK, how you going?
Well, thanks, Phil. I was just saying, but feel a bit guilty being in Brisbane these days. We've got it pretty good, but not complaining.
And has Brisbane always been home for you, PK?
I was born in India. We grew up in New Zealand, small sort of town called Napier on the east coast of the North Island.
Lovely.
Moved over here in 2006.
Okay. What was the move from New Zealand to Australia? What was the back story there, mate?
Oh, look, nothing remarkable really. I think, we just wanted to sort of typical sort of Indian background and upbringing. My parents sent me to an Australian university, which is apparently better than in New Zealand. So that was really the story there.
Well, you said it, mate. But what did you do at university, PK?
Finance and statistics. Really looking at econometrics and things like that.
Wow, that sounds exciting. Yeah, you're happy you did that as a degree?
To be honest with you, I just wanted to get the degree over and done with, not terribly academic, but I love numbers and just wanted to start working so I can earn some money.
Yeah. Which uni in Brisbane did you go to?
UQ.
Okay. Oh, it's a good school. And statistics, where I went to university, everyone had to do Stat 101, it was called, and it was a requirement and everyone absolutely hated it. I know one bloke who is now a doctor. He's a geologist and he failed it 3 times. It was an ongoing joke. But Stat 101 at Macquarie University, thank God you're behind me. Anyway, statistics are a big driver, though, of helping to make informed investment decisions. We chat about it a lot. You can't always rely on the numbers. The most successful property investors I know have a really comfortable relationship or intersection between the numbers and what's actually going on. That's what you need to do. But your investing journey, PK, how old are you, mate? You don't look that old.
I'm 31, Phil.
You're 31. And how many properties do you have right now?
So we have 9 resi properties, 8 of them in Australia and 2 commercial developments.
Okay. You're not messing around and you say we, is it yourself and someone else?
My wife, yeah.
Okay. All right. So you invest in a partnership with your wife?
You could say that.
You could say that. That's cool. So take me back, PK, the catalyst for you to invest in property. When did you buy your first property? Were you still at university or was after that?
Right into our first job. So we graduated 2010 from uni, and I mean, we came from pretty, second generation immigrants. So, pretty sort of humble background. And my wife and my parents did all the hard yards for us. So we're pretty grateful. And, they worked pretty hard. So we just wanted to get ahead as soon as possible. We started investing from the first year of getting our grad roles.
Oh, okay. And what did you both do as grads straight after uni?
So, I mean, I was a bit of a nerd. So I went into investment banking at JP Morgan, actually in Sydney. And she was a chartered accountant at KPMG.
Okay. So you got numbers flowing through your veins there. And how long, so you started your grad role. Did you work through university at all?
I did internships in every summer. I picked fruit. I worked at the local fruit shop, various things, just trying to get the savings up and basically live.
Yeah, no, well, absolutely. And did you live at home while you were at university? Okay.
Yeah, I did.
That always helps. And like mum did all your cooking and cleaning and you
cooking, cleaning, everything under the sun. Yeah.
So how much? So let's talk about that first property. Whereabouts was it, PK?
So the first one was in East Gosford, in New South Wales. So that was in 2011, start of 2011.
Okay, East Gosford. I bet you've done pretty well there. What did you pay for it?
So that one, the purchase price, I made some notes because I know you're going to ask me these. There was about 320. Okay. 321 or something, like 320, 2011. And yeah, back then it wasn't such a hot market. I mean, no one was really looking there like they are now, but yeah, it's done pretty well.
And what was that, a house?
Standard, 3-bedroom, two garage.
In East Gosford, so 320K. And you rented it out straight away? Was it investment property from the get-go?
Yeah, investment. Yep. I was living at home still for the majority of the portfolio. Okay,
so so you're living in Brisbane. You invested first in East Gosford.
Yeah.
Okay. Why East Gosford?
Well, I mean, like I said, the purchase price was low 300s. Like before my wife and I, well then girlfriend at the time, before we sort of started investing in properties, we really wanted to understand the data. There's lots of sort of seminars and webinars and stuff like that we attended. There was no podcast like this, I don't think, back then. Correct me if I'm wrong. So yeah, we just built a bit of a method using numbers, using data ourselves. And where we lived in Brisbane, it just wasn't stacking up. And you can kind of see that in the last 10 years, kind of take away this year, Brisbane's not really done super well. So that kind of took us to East Gosford, where a lot of the data was pointing, and it was affordable and positive cash flow. Yeah,
well, I think Brizzy's going to have its day in the sun, and we'll have a chat about that in a moment. But what did you rent it out for, PK?
So the rent was $400, which was the great thing about it. So,
and how much deposit did you put in?
We put in 80% deposit for that one. Sorry, 20% deposit.
Okay, 20%. So it was positively geared pretty much from the get-go? Yep. Okay. And you bought it in your own personal names? How did you structure it?
That was in a trust structure.
In a trust structure. Okay. So you had to pay land tax on it from the get-go.
Yeah.
Yeah, which is one of the prices you pay for investing in trust, but we'll get into that. Okay. And you still have the property today?
Still have it. Okay. Yeah, haven't sold any.
So what do you reckon the valuation of that property would be today?
I haven't got it recently valued, Phil, but I reckon it could be somewhere around maybe 800 to 850. Maybe that's being a little bit liberal, maybe high 700s, something like that.
Yeah. So you're still doing okay out of it 10 years on from 320. You've at least doubled your money. You probably get 120, 130% growth on that. So
yeah,
can't complain. And a 20% deposit on 320. So, plus your stamp duty and stuff, you probably would have needed to find about 80 to 90K. And that was just savings, was it, from your first job and working through university?
Yeah, I did an internship at Macquarie Bank and a couple of other investment banks. They pay you like $10,000 a summer. And my wife was a cadet at KPMG through university as well. So that was basically all of our internship money.
Yeah. Okay. And so did you actually go and travel to see the house before you bought it?
No. So that's the thing. And, for me, I mean, a little bit stingy. I didn't want to pay, flights every weekend to inspect properties and everything like that. So I was just trying to figure out how to actually buy interstate. And I called a couple of property managers that were local to the area and said, if I find the right property, will you be okay enough to inspect it for me? Like, I'm happy to give you $100 or $200, something like that. And they actually said, I mean, this was back in the day and now it's much more common, but they actually said they're happy to do it for free as long as I was serious and as long as they, I would give them the management to them. So I think they must have inspected 4 or 5 properties before this one. And we bought it. I mean, I wouldn't say sight unseen because they did the due diligence, but we didn't go down there.
Yeah. And you stayed with the manager? You still got the same manager today on the property?
I think the business has been sold and bought a couple of times since that time.
Yeah. But still continuity. Okay.
Yeah, exactly.
That's cool. All right. So that's 2011 in East Gosford. So for those of you that don't know where East Gosford is, bottom of the Central Coast in New South Wales. It's probably only about, with the new tunnel there through the start of the M1. It's probably less than an hour from Sydney now. So, nice and close. And you'll do well over time there, East Coast. So what was the second property, PK?
So the second one was in Frankston in, just south of Melbourne, southeast of Melbourne. That one was, again, similar sort of price, $315. The valuation, or my valuation, came out based on comparables at $340. So kind of made sense for me. And it was renting not as good as the first one at $310, but still positive cash flow. This time we went 12% deposit.
12% deposit. Okay. And you buy that also in a trust structure?
Yeah, that was in a trust structure as well.
Okay. All right. And today, what sort of value do you reckon you'd have on it?
I reckon, back then it was a bit of an ugly duckling and Frankston's still not for everyone, but it's gone up to about, I'd say 700 to 750, something like that at the moment.
Okay. Yeah. And sorry, when did you buy that?
That was in 2012. So, about a year after the first.
And you had a 12% deposit. So a little bit less than the sort of 20 that lenders like you to have. So, and you had to pay lenders' mortgage insurance, LMI, as a result of that?
Yeah. So actually, because my wife was an accountant, we didn't need to pay it, but we didn't find that out until like the 5th property. So for some reason, our broker didn't tell us. So we were still paying lenders' mortgage insurance, even though we didn't need to.
So you're saying because because you had a professional package, because you're an accountant, they don't charge LMI. Some lenders do that.
Yeah, I think if you're a nurse and chartered accountant and a few other professions, they don't charge you LMI.
Because they think you're a little bit more stable than everyone else, do they? So you're paying LMI all this time, and you didn't know that you could have got products out there that you didn't have to pay LMI on. Did you change brokers when you found out?
We didn't change brokers immediately because the guy was really good as well. But we've moved on a couple of times since then. So
12% at 310 on 315 property in a trust. Was that positively geared? It would have been.
That was I was about neutral at the time.
Yeah.
We were on pretty good income. So we were thinking we don't want to buy negatively geared property, but it doesn't need to give us $10,000 a year from the get-go. Yeah.
And where'd you get the cash to stump that up? Did you just save money through working again?
Yeah. So we'd worked the whole first year of our grad roles by then and saved up.
And what were you like with your salaries? Were you still living at home at the time?
No, so like I said, I was down in Sydney at JP Morgan for that first year. My wife was based in Sydney as well. She was living at home, but I was renting. And this is the thing that probably people need to know in building large portfolios. We were on, very grateful to say we're on pretty good incomes. So combined salary at that time would have been about 200. So, we were able to save and get that second property pretty quickly. I think the first one had gone up maybe 40, 50K in that first year, but 40, 50 is not enough to be able to go again that quick.
Yeah. And no doubt at that time, lenders would have quite liked you, two people, PAYG, in sort of banking and finance roles. It's pretty easy to get that like that. And what about your sort of living standards? Were you sort of watching your pennies, or were you sort of driving fancy cars and eating out every night?
No, I didn't have a car. And I think my wife bought like an old, $14,000 car just to be able to, hang around on the weekends. But I was working about 90-hour weeks at the investment bank, and I was having breakfast there, lunch there, dinner there, all funded by the bank because, we were there 90 hours a week. So I didn't have many expenses just because I was a how do you say? I was basically living at the firm.
And so you just rocked up and there's always food there, or they ordered it in for you?
Yeah, I mean, there's always food there because I suppose that's the lifestyle that they need to facilitate for you to do a good job.
Was it good food? Was it like healthy? Was it just like crap, like chips and sausage rolls and stuff?
Well, I'm vegan, Phil. So like back then, veganism wasn't the biggest thing. So I was always scrounging around for something I could eat.
It's good to keep the weight off. Yeah, no, it's good. Well, I want to continue down this journey of understanding your portfolio, PK. We'll just go to a quick break. Back in a moment.
Are you wondering where to buy an investment property right now? Why not let buyers take the guesswork out of it? We can find you the right place on or off market at the right price. An investment professional from our national network of buyers agents can help you save time, money and stress and deliver you a tailored solution. Talk to us today. Call 1800 975 051 or visit buyersbuyers.com.au.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with PK Gupta, chatting through his portfolio. And just the two I've seen there so far look pretty good foundational. Tell me about properties 3 and 4, PK.
Yeah, so number 3 was again I think a sort of good one. So that was in Mountain View Drive in Kingston and Tassie. Okay. Bought once again similar price range. It was 311. Rent was 350, so a little bit better rent this time. Tassie, as you know, you got to pay land tax basically from the get-go. That was not in a trust structure this time. That was in my wife's name. And yeah, I mean, once again, sort of it grew basically from year number 1 because we tried to follow the data as best as we could. And I think that was probably even better than the first 2 properties. We'd learned a few things by then, calibrated our data system methodology and really just continued to rely on local property managers.
And that was, when did you buy that?
That was 2013, so another year later.
Another year, okay. And again, you just saved the money up through working. And what sort of debt did you take on that?
So we just continued to go 12% deposits.
Okay, and again, LMI. So, but on a $315,000 property, 8% difference on the LMI, it's probably not a lot of money. It's probably like $2 or $3 grand thereabouts.
Yeah. I mean, it was more the principle of, just kind of keeping the money, our deposits with us to preserve them for future deposits. That was just kind of the principle we were working off. And
where you are capitalising the LMI into the loan, and what that means for those listeners that are not too familiar, but it means they just, if you've got a $300,000 loan, it's $3,000 with LMI, your loan becomes $303,000. Is that what you were doing?
That's exactly right.
Okay.
And you can then, as you know, Phil, you can claim that in tax over a 5-year period. And if you refinance that, then you can get it all in one go. Yeah.
And Kingston, Tassie, 2013 to today, you're probably just in there as that market was really starting to fire. What sort of hour do you reckon you'd have on that today?
So I think it would be kind of mid-6s at the moment. It's there's been a bit of development around there, a lot of new houses, but at the same time, demand, as you might know, is just shot up through the roof. So I think it's done pretty well, and the current rent is about $530. So that's that's kind of really a good news story in terms of the passive income that it's giving.
Oh, very nice. And then probably number 4.
So this is probably not the best property. We bought in Mount Sheridan in Cairns. Okay. So we bought it for about $400,000. The rent was $400. We failed to recognize that the insurance premiums are quite high up there. So it was slightly negative pre-tax, post-tax, or after depreciation, it was basically break even.
Yep.
But it hasn't really done much. And I think, for those people who are listening, it was just this classic sort of, hey, Cairns hasn't moved for 10 years. Yeah, Aussie dollar is really low. Tourism's booming. They're going to build a casino. Let's just get something in Cairns at the bottom of the market. And, 4, 5, 6 years later, it's kind of gone up a little bit, but it's not done much.
Don't worry, everyone's got one of those properties in their portfolio. Tell me about property number 5, PK.
Yeah, so this is probably the best one that I'm super, super proud about, Phil. So this was in Islington in Newcastle, and back up to where we did well. So it's 2015 now. Bought it for $507,000 on Christmas Eve. Okay. This was listed in late November 2015 for I think it was $570. Then they brought it down to $550, and then they had just become frustrated, and we gave an offer of $507 on 2 days before Christmas, and on Christmas Eve they settled at, or they agreed to 507.
Yeah, so they just wanted the shot of it.
Yeah.
Do you know the reason why? Was there a backstory at all why they had to get rid of the place?
I think they bought another place to move into, so they kind of really needed to make that sort of transition happen over the Christmas period, and all the way up to sort of Australia Day. Property markets aren't terribly on fire; they're kind of slowing down and stuff. So they were just wanting to get rid of it, I think.
Yeah, cool. And what sort of rent were you getting on that?
So we got $480 rent straight off the bat. The valuation, the actual bank valuation, which is pretty rare, came out at $550. So the bank valued it at much more than what we paid for it.
That's good. And again, were you borrowing 12%?
Yeah.
Yeah. And the banks and the lenders are still happy to give you money? Yeah.
Yeah, I think, and once again, it's not like there's any secret sauce here. We were on even higher incomes by now, so we were probably earning close to $300K as a couple by 2015-16. So banks saw the positive cash flow. The APRA rules hadn't really come in to a huge effect by this time, and they were still happy.
Okay, cool. Property 6.
So property 6, finally bought back in where I was living in Brisbane, so Ferny Hills.
Okay.
Purchase price was $480. Valuation was basically the same. This one was our first negatively geared property. The rent was $440. We thought we'd get $480, but literally the rental market shifted within 3 months from point of offer to settlement by about $50 a week. So that wasn't great, but that's done well.
Okay. Property 7.
Property 7 was down in Tassie again, in sort of northwest Tasmania, a place called Burnie.
Okay.
2016. Yeah, Burnie's really good. I mean, since that time, the population of Burnie's actually gone down, but property prices have gone through the roof. And that's just because a different type of demographic has moved in. We got that for $230. The rent was $260, so back into positive cash flow territory, paying more land tax, but it is what it is.
There you go. Property 8, Resi.
So property 8, Resi, is in Peachtree in Brisbane again.
Good spot.
2017, bought for $350.
And these are all houses, right?
Basically, all of them are 3-bedders. Yeah.
Yeah. Okay. Peachtree, so that's where that new Sunshine Coast University is. So no doubt not far from there. Is that what sort of attracted you to the area, that sort of potential growth?
To be honest with you, Phil, that was a nice bonus to have at the time, but I'd kind of been burnt by sort of just following infrastructure and things like that up in Cairns. When it comes to infrastructure, there's planning phase, there's the feasibility phase, there's the approval phase, funding phase. It can fall over at any point. So I didn't buy it because of the university. By that time, we'd sort of calibrated our system, and we were really just following the methodology, looking at stock on market, inventory levels, days on market levels, a whole bunch of statistics.
Yeah. Okay. Property 9.
So property 9, this is the last residential one I actually bought this year. And this was overseas. So this was in a sort of tourist area in India.
Okay.
We got it for a purchase price of $420K, and it is valued at $600K. So, things happen a little bit different in India, and we were able to sort of haggle it down to a good price.
So $600K, you bought it for $400. Which is where's the area?
So it's in a state called UP, Uttar Pradesh, in a town called Vrindavan.
Okay.
Things work different that way. If you got to know local people, you got to know how to give them money. We paid half of this, under the table, half of it over the table.
Okay, that's no doubt the Indian tax system operates a bit different to the ATO, but
hopefully they're not listening to this.
Yeah, I'm not an expert in that. My recommendation is always pay your taxes, but anyway. And what's the game plan with that? Is that like a holiday house, or are you going to use it, or what's the play?
Yeah, I mean, the idea of that is it's actually a tourist hotspot. So lots of Americans and European people go. This is really near the Taj Mahal in Agra. Okay. So you could say it's kind of like the equivalent of an Airbnb. There's a different platform that works in India. And over the long term, if we want, then we can just spend some time there, my wife and I and our son, if we want to.
Are you guys from the same, what are they called in India? There's not area. You don't have counties. You have the same province. Did I get that right?
Province, it's called states as well.
Yeah, the states. Yeah. Are you from the same state, yourself and your wife?
We're from different states, actually. So I was born on the north side, quite near New Delhi, and she was Indian origin, but she was born in East London, in the UK. So, yeah.
Oh, very cool. So that was probably number 9. Are you going to buy any more offshore stuff, or is that just a bit of a play? Like, is that an income-producing property? You're going to keep the money in India? What's the plan?
Yeah, so I mean, that was, you shouldn't really combine pleasure and investment, but that was our combination of pleasure and investment. We're going to keep that one. It's going to give us a lot of income in the short term, I hope, at least.
Yeah.
I mean, we've just bought it recently. And then, like I said, over the long term, if we want, we can go and occupy that if we want to spend some time in that part of India, which is really beautiful. And in terms of like future offshore investments, I mean, we don't have any money in cash right now, but when we do save up and have that ability, we actually want to buy in the US, just to kind of have the ability to move there for short periods of time if we want to. But it's very expensive, especially where we want to go over there. So it'll be a little while away.
Yeah, no, it's sort of portfolio that a lot of people would like to build as a foundational point. From a foundational point, no doubt this will hold you well moving forward. What's the total valuation of the Resi portfolio, PK?
Yeah, so including the one in India, it's about touching 5. So I think it's about 4.7 or 4.8 or something like that. Okay,
and how much debt are you carrying on that?
There's about 1.6 or 1.7 mil of debt at the moment. And
what's the LVR position? That's good. You're good with numbers. 32.8%.
Yeah, something like that. Yeah, it's about a third, right? And the reason the debt is so low is that we've been working our asses off, basically. Working really hard, the both of us, in our jobs. And trying to pay those properties down to some extent.
Well, let's have a chat about that. So we'll go to a break before, and when we come back, we'll get into that because that's an interesting strategy. Back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back, everyone. Phil Tarrant, Smart Property Investment with PK Gupta, chatting through his portfolio. So before the break, PK, you said that you've been, you gave us the LVR position, so 30-odd percent, 4.8 million valuation, 1.6 million in debt. And a lot of people would say, what are you doing? You guys should be going harder right now. But it depends where you sit on the risk curve. So all these mortgages, are they principal and interest? Are you paying them down over time? Is that the plan?
Some of them are, Phil, on P&I, but I mean, our plan is really and when I gave you that equity position, that includes the offset money, the capital and the offset. The plan is to just have that liquid cash available if we want to do something with it. I think we're not as diversified in other asset classes like shares and other things. So we don't want to be going too much more into residential property in Australia. I mean, different strokes for different folks. But that's why we have that money in the offset to kind of do something else with in the future.
And that makes sense. So PK's talking about an offset account. So the way that works, if you're not familiar with them, and I'll be really general with this, if you've got $500,000 of debt on a property, and then if you put $500,000 in cash in your offset account that's connected with that property, you'll pay zero interest if it is just a principal, if it's just an interest-only loan. So what it does, it offsets the amount of money that you're exposed to, and therefore you pay less interest. And it's a really good strategy if you're looking to build up cash for another purchase or for some other utility in time in a different asset class, have it sitting in an offset. So if you've got interest rates of 4% and you've got a completely offset, it means you've got a 0% interest rate. So it's a really good strategy for conserving cash. And what a lot of other people do also is that if they do a refinance, and they realise some cash getting ready for next purchase, they'll chuck in an offset until they're ready. So you're making that money work for you. Much better than it sitting in a savings account where you're lucky to get 0.1% at the moment. So if you need any more information about that, go and speak to your mortgage broker. They can help you out. Now, where on this journey, PK, did you start investing in commercial property?
So we started doing commercial developments about 4 years ago, Phil. And when I say developments, that just means, I didn't quit my job and all of a sudden do this. I teamed up with some business partners, and mostly here in Brisbane, places like Morayfield, Logan, and a couple of other localities. We're doing service station. We did a childcare center. One was a combination of the two. And I was basically a silent money partner, as well as doing some funding, kind of helping the project that way. And my business partner is civil engineer. So he was kind of doing, the more sort of roll up your sleeve, hard sort of dirty work. And through that, we're able to make more lumpy, you could say, sort of chunky profits, for want of a better word.
Yep.
And then the buy and hold commercials was just this year. Okay.
And what's your buy and hold commercials?
So we got two. The first one was up in, is up in Townsville, in Garbutt. That's standard shed. It's got, I think there's a panel beater, there's a paint guy, and what is like a boxing gym or something like that.
Okay.
Side by side. It's pretty cheap, about $440 we paid for it.
Yep.
Needs a new roof, which is going to cost me about $50,000. But once we do that, I reckon, I haven't got a valuation or anything, but I reckon that would be about 600.
Okay. And I imagine pretty good cash flow out of that?
Yeah. So that was a really good deal. The cash flow, I think before expenses, about 50,000. After your property management fees, the tenants don't pay the outgoings in this case. It ends up being about 35. So I think, gross about 8 or 9, maybe 6 or 7 net, something like that. And
the portfolio you've built, you've diversified out into commercial assets. To your point, you'll probably go wider in your asset base, but you're still young, mate. What's been the secret to your success? Or number one, do you think you've been successful? And number two, the answer is yes, which it probably should be. What's your sort of, what's made this so right for you? What's your sort of guiding sort of force in making these investment decisions?
Yeah, it's a really good question. I think success is really fulfilling your potential. So different people are different, and as long as you fulfill whatever potential you have, that's success. So, from that perspective, I think we've got a long way to go, hopefully. But there's no sort of magic source, like we said, or like I said. There was no sort of rags to riches story and, living in a caravan or anything like that. We're on pretty good incomes. We work really hard through our childhood to get a good education and get good jobs. We work very hard in our jobs. And that's really what you need, right? You need the serviceability, especially in this day and age. But really the secret, or you could say what we stressed most, was data. You mentioned earlier, Phil, that, all the good investors, they have a really good balance between being data driven, but also being kind of prudent in the sort of more, you could say, less quantitative things. But we really skewed that equation much more heavily towards the data. And back when we started, there wasn't that much data out there. And I had a background, like I said, in statistics. So I just compiled a lot of the data that I could and ran, there's a bit of a nerdy term, something called multivariate regression analysis, which just allows us to understand, of all the data factors out there, what are actually meaningful, what have a meaningful coefficient, what are their respective weightings. And we just sort of use, these data factors. They're not secrets.
So on that basis, then, did you make your own determination of what data points were the most important? You created your own indexing score to say, hang on a second, I chuck all these numbers into this pot, shake it up, and then these ones are the highest. What would be the sort of the core or the primary data points or the primary data indicators which for you would indicate investability in a particular area and or asset?
Yeah, it's a good question. Like, we use 30 to 35 data factors, but there's this sort of 80-20 principle. Basically, if you look at stock on market percentages, days on market trends, online search interest ratios, average vendor discounting, building approval schemes around, where you're looking to invest, mortgage affordability is obviously an important one, job advertisement trends, et cetera, et cetera. And it's not just the coefficients or the weightings or the indexing, as you put it, but it's also the thresholds. Like, for example, we found that on average vendor discounting needs to be less than 5% and trending down, along with other things stacking up for the balance of demand to start pipping supply. And so when you can actually do this quantitatively, you can sort of sit back and say, all right, I don't know anything about the Australian property market. I'm just going to let the data speak for itself, start with the 15,000 suburbs and, make your way downwards. And then, like you said, you have your local property manager, you have other things that you can just find online like flooding and, bushfire zones and flight path corridors. You can kind of overlay that qualitative stuff and, kind of sandwich together where you should buy quantitative top down and qualitative bottom up.
So for those of you that aren't data nerds, quantitative and quantitative being numbers and qualitative being sort of more narrative. So what's the story around it versus what are the numbers saying? I guess a very important thing to take from this is it's good to embrace data, and you got to know data to be a good property investor. But the best people I've seen use data don't have what's called confirmation bias, where what PK is saying there is that you start at 15,000 properties and then without any bias or agenda and work out what it is, rather than going, hey, I think this suburb is really good. I'm going to use data to prove to me that it is good. Don't do that, because that's how you end up in trouble. But PK, mate, great story. When you sort of get any more offshore stuff, come and have a chat with us, mate. I want to understand how that works for you. And so the property in India, did you buy it all in cash? Have you got any debt on it?
That was a cash purchase.
Okay.
They wouldn't lend me over there.
Yeah. But I really like to uncover that journey as you go through that. But keep at it, PK. You're doing well there. It's a really good portfolio. The debt position is great. Paying off the loans, that might work for you. It might not for other people, but no doubt you're getting ready for that next big purchase. So when you do that, come and have a chat with us, mate.
Yeah, awesome. No, 100%. Thanks for having me on, Phil.
Nice one. That's PK Gupta, property investor. These are the stories that we like. And to put it in perspective, only about, it's a tiny fraction of Australian property investors own more than 6 properties. So PK is one of those. Don't think that every property investor in Australia's portfolio looks like PK's. Most property investors in Australia only have between 1 or 2 properties, and that is the norm. So you need to make sure you get those first 2 absolutely right if you want to go out there and build a portfolio. But these are the stories that we like to have on a Smart Property Investment Show. Remember to go and check out the website, smartpropertyinvestment.com.au, social media, Smart Property HQ. And a favour for me, no doubt, PK is going to do it as soon as we finish, because I'm going to look tomorrow. He's going to leave a review for us on iTunes or wherever he listens to the podcast. I get to do the good bit of this, and that is have the chat with the property investors about this big team here that make me sound good and get these great guests coming on the studio. They get a real kick out of that feedback. So if you can do that for me, that'd be great. To be a favour. I'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.